Stop what you're doing right now, this second. Put the coffee down, close the other tab, turn the volume up, and stop checking your phone. She will never match you back. Look at me, this matters. Are we clear? Good. If you own silver, physical silver, do not sell a single ounce, do not place a limit order, do not listen to a single talking head on television until after you finish this video. Because what just happened today changes everything, and I do not use those words lightly. Something snapped, something broke, something that, in a functioning market, simply cannot happen, just happened anyway. The silver price did not creep higher. It did not grind up. It exploded, nuked, squeezed past levels that were supposed to be years away, not whispers on a screen this morning. And the worst part, most people still have no idea. Ladies and gentlemen, this is Paper to Atoms. It is 29th of January, 2026. And I'm about to tell you something that the paper market says is impossible, but the numbers just confirmed anyway. Yesterday, January 28th, we talked about something that most of the financial world tried to ignore. We talked about tightening inventories. We talked about rising physical premiums. We talked about delivery stress quietly building behind the scenes. And I told you that the paper price of silver was lying. We talked about the Shanghai premium blowing out while Western spot prices pretended everything was normal. We talked about COMEX open interest refusing to fall even as registered inventories kept draining. We talked about industrial buyers stepping in quietly, not chasing price, but chasing metal. And I told you that this was not sustainable. I told you that something had to give. And you know what happened? It gave. Overnight, silver did not just move higher, it detonated. Futures blew past resistance levels that had capped price action for over a decade. Stops were triggered, shorts were forced to cover, liquidity vanished, and when liquidity vanishes in a leveraged paper market, price does one thing and one thing only. It gaps violently. What yesterday looked like tightness turned into today's panic. Yesterday, analysts were debating whether silver could hold triple digits sometime this year. Today, we are staring at confirmed trades above $120. Let me be very clear. This was not caused by retail buyers. This was not caused by Reddit. This was not caused by speculation. This was caused by stress that had been building for years, finally surfacing all at once. Yesterday was the warning shot. Today is the escalation. And what makes this moment so important, so critical, is that every single excuse that used to explain silver's suppression is now gone. Rates did not spike. The dollar did not collapse overnight. Inflation expectations did not suddenly change. Yet silver still surged. That tells you everything you need to know, because when price moves without the usual excuses, it means the system itself is breaking. And that brings us to the core issue, the thing you must understand before this market moves even further, even faster. Here is the thesis. This is the core. This is the part you need to lock in because everything else flows from this. Silver traded and settled above $120 per ounce today, while the underlying paper structure that is supposed to control price did not change. The same exchanges, the same banks, the same leverage, the same COMEX, the same CME rulebook, the same bullion banks that have capped this market for decades. In a functioning market, this is impossible. Why? Because silver is one of the most heavily shorted, most leveraged, most paper-diluted commodities on Earth. Price discovery is not supposed to happen in the physical market. It is supposed to happen through futures, through derivatives, through paper contracts that outnumber real ounces by orders of magnitude. Under that system, price spikes are contained. Volatility is crushed, rallies are sold, always. Except this time, it did not work. This time, price broke through anyway. Not on hype, not on headlines, but on stress. What you are witnessing is not a rally. It is not momentum. It is not speculation. It is a failure of containment. And I am going to prove that to you with numbers, with data, with evidence that even the most skeptical person cannot deny. We are going to walk through exactly what changed, exactly where the pressure is coming from, and exactly why this move cannot be walked back without consequences. Because once a market exposes the gap between paper promises and physical reality, that gap does not quietly close. It widens, it accelerates, and it forces decisions that nobody wants to make. So buckle up, focus. Let me show you exactly what happened, starting with the numbers. Let me start with the numbers because numbers do not lie. Politicians lie, bankers lie, the media lies. But mathematics is truth. Yesterday, January 28th, silver closed on the COMEX at $97.40 per ounce. That alone was already extreme. That price represented a more than 240% increase from the lows just a few years ago, and yet even at that level, the paper market insisted everything was orderly. Now fast forward to today. In early Asian trading, silver futures ripped through 103.50, paused for less than 20 minutes, then blew straight through 110. By the time London opened, we saw confirmed trades at 118.90. And before New York even had its first full hour of volume, silver printed 121.35. Let me say that again so it sinks in. Silver moved from 97.40 to 121.35 in less than 24 hours. That is a 23.95 move. That is a 24.6% increase in a single trading session in one of the largest, most controlled commodity markets on Earth. In a normal market, a one-day move of 3% would trigger headlines. A 5% move would spark emergency commentary. A 10% move would cause trading halts, margin reviews, and outright panic. This was almost 25%. Now let's talk spreads, because this is where it gets really interesting. Yesterday, the Shanghai Futures Exchange was already showing silver trading at the equivalent of $104.80 per ounce after conversion. That represented a premium of roughly $7.40 over COMEX pricing. Elevated, yes, but not unheard of. Today, Shanghai silver printed the equivalent of $132.20. That is a $10.85 premium over Western futures after the COMEX explosion. Let me be very clear about what that means. Even after silver surged past $120 in the West, buyers in the East were still paying significantly more for real metal. That is not arbitrage noise. That is physical demand overwhelming paper supply. Now let's look at inventories. As of the most recent COMEX report, registered silver inventories stood at just under 23 million ounces. Eligible inventory? About 91 million ounces. Metal that is not for sale unless owners are willing to part with it. Total open interest on COMEX silver futures? Roughly 168,000 contracts. Each contract represents 5,000 ounces. That is 840 million ounces of paper claims standing on top of barely 23 million ounces of deliverable metal. That is a leverage ratio of more than 36 to 1. And today, instead of open interest collapsing, as it normally does during a spike, it held firm. In some contract months, it actually increased. Let me say that again. Price exploded. Inventories stayed tight. Open interest did not fall. That means shorts were not closing. They were trapped. And when shorts are trapped in a market with no spare physical supply, price does not stabilize. It surges violently. Historically, the largest one-day silver move before this was in 1980, during the Hunt Brothers episode, when silver moved roughly 17% in a single session. In 2011, during Silver Sunday, we saw multiple 7 to 9% days, but never this. This move is larger, this move is faster, and this move is happening in a market that is supposedly more regulated than ever. Three things have happened: the paper price has disconnected, the physical market has asserted control, and the leverage has been exposed. And that sets the stage for why this moment is not just dramatic, it is unprecedented. Now, let me put this in perspective, because I do not want you to think I'm exaggerating. I do not want you to think this is just another wild commodity story that will fade from memory in a few weeks. In a normal market, moves like this do not happen. In a normal market, price discovery is gradual. In a normal market, arbitrage fixes dislocations quickly and ruthlessly. But today, there is nothing normal about silver. Let's go back in time for a moment. In 1973, during the inflation shock, silver rose steadily as confidence in fiat currencies cracked. Strong move, but inventory was available. In 1980, during the Hunt Brothers episode, silver went vertical, but that was driven by concentrated buying and was crushed by rule changes. In 2008, silver collapsed with everything else because liquidity vanished. In 2011, silver ran hard, hit $49, and was violently smashed with margin hikes on Silver Sunday. Every single one of those events had something in common. Arbitrage still functioned. Metal could be moved, contracts could be settled, pressure could be released. But today, the arbitrage is dead, not difficult, not expensive, dead. Let me explain why. If silver is cheaper in the West than in the East, arbitrageurs are supposed to buy in the West, ship the metal, and sell it in the East. That closes the spread. That stabilizes price. That restores order. So let me ask you a simple question. Can we not ship silver from New York to Shanghai? Of course we can. Can we not melt bars, recast them, and deliver them into Asian vaults? Of course we can. So that is not the problem. The problem is that the metal is not there to ship. COMEX inventory is not low. It is functionally spoken for. Most of what remains is either pledged, encumbered, or sitting in strong hands that are not selling at any price near spot. At the same time, industrial demand has become inelastic. Solar manufacturers, electronics producers, defense contractors, they cannot substitute silver. They cannot wait. They cannot hedge production delays with paper promises. So when price explodes and arbitrage should step in, it does not, because the arbitrage requires physical supply, not paper contracts. And here is the key insight you need to understand. In every prior silver spike, Paper selling eventually overwhelmed physical demand. This time, physical demand is overwhelming paper selling. That is the inversion. That is why this is unprecedented. We are watching a market where futures no longer lead price. They are chasing it. Where exchanges are reacting instead of controlling. Where price is being discovered not by leverage, but by scarcity. And once scarcity becomes the dominant pricing mechanism, the old playbook stops working. That is why what happened today cannot simply be undone. That is why this is not a blow-off top. And that is why the next move, the one you have not heard about yet, is even more important. Because now we need to talk about what they did in response. Now let me tell you what happened this morning that makes today's move even more significant, and frankly more dangerous for the people on the wrong side of this trade, because the silver price did not explode in a vacuum. It exploded despite intervention. In the early hours of today's session, the CME quietly issued an emergency notice, not a headline, not a press release, a notice, the kind they hope nobody reads. They announced intraday margin adjustments on silver futures. Initial margin requirements were raised sharply, maintenance margins followed. In plain English, they made it more expensive, much more expensive, to hold long positions. They did this specifically to force weak hands out of the market. They did this specifically to slow the rally. They did this to protect the banks who are short. This is not speculation. This is standard operating procedure. When price moves against the bullion banks, JPMorgan, HSBC, Bank of America, the exchange does not ask questions. It changes the rules. And for about an hour, it looked like it might work. Price hesitated, volume spiked. Commentators rushed in to say, this is the top, this is exhaustion. But then something happened. Silver did not fall. It absorbed the margin hike like it was nothing. It consolidated for less than 90 minutes, and then it ripped higher again, harder than before. That is the tell. In 2011, margin hikes killed the rally because longs were leveraged and metal was available. Today, margin hikes barely slowed price because the demand is not speculative. It is compulsory. Industrial users do not care about margin requirements. Sovereign buyers do not care about margin requirements. Long-term holders with physical delivery intent do not care about margin requirements. So the CME pulled its favorite lever and nothing happened. This is the same playbook we saw on Silver Sunday 2011, except the outcome is different. Back then, paper selling overwhelmed demand. Today, paper selling is being absorbed instantly. And let me be very clear about why that matters. The exchanges only have three tools: margins, position limits, rule changes. They have already used one, and it failed. If they escalate further, they risk something far worse than a price spike, a loss of confidence in the contract itself. Because once participants believe delivery is uncertain, the paper market ceases to function. And that is the nightmare scenario for the banks. Because if the futures market loses credibility, price discovery moves entirely to the physical market. And in the physical market, the banks do not set the price, supply and demand do. This is why you are seeing panic behind the scenes. This is why liquidity vanished. This is why volatility exploded. And this is not just about silver. Because while this was happening in New York, something else was unfolding around the world, and it confirms that this move is part of a much larger shift. Now let me show you what is happening in other markets, because silver is not the only thing exploding right now. And this is where you need to widen the lens, because if you are only watching COMEX, you are missing the real story. In Shanghai, silver is not being traded like a speculative asset. It is being treated like a strategic material. Premiums did not compress after the Western spike. They expanded. Physical bars are changing hands at prices equivalent to $130, $132s, even $135 per ounce depending on size and purity. Why? Because buyers there are not asking, what is spot? They are asking, do you have metal? In India, the situation is even more revealing. Wholesale dealers are reporting delivery delays stretching into weeks. Retail premiums on coins and small bars have jumped to levels we normally only see during crisis periods. Indian buyers are paying the equivalent of $15 to $8 over Western spot, and they are still buying. In the West, dealers are quietly pulling inventory, not advertising it, not discounting it, just letting it sell out because they know what comes next when replenishment costs jump overnight. Now look at gold, because gold always tells the truth before the headlines do. Gold did not lag silver. It followed it higher. Gold cleared $4,200 today and held. No smash, no reversal, no risk on, risk off nonsense. That tells you this is not a speculative metals trade. This is a confidence trade. At the same time, the bond market is flashing red. Yields are volatile. Liquidity is thin. Buyers are selective. When bonds wobble and metals surge together, it is a signal that capital is looking for certainty, not yield. And then there is China. China has been steadily increasing strategic metal stockpiles for years, but recent customs data shows a sharp acceleration in silver imports, not for investment, for industry, solar, EVs, electronics. These sectors do not slow down when price rises. They compete harder for supply. And let me ask you something. If you are Tesla, Samsung, TSMC, or a defense contractor, do you care if silver is $40 or $120, or do you care if your production line shuts down? Exactly. Industrial buyers are price takers. They always have been. And right now they are stepping on the gas at the worst possible time for the paper market. So here is what we are seeing globally. In the East, physical silver is being hoarded. In the West, inventories are being drained. In industry, demand is non-negotiable. 3 forces, 1 market, no buffer. And when all of that pressure converges, something very dangerous happens. The illusion of a single global spot price starts to break down. Which brings us to the most important deception of all, the lie that could cost people everything if they do not understand it right now. Now let me tell you about the $120 trap, because this is where people get hurt. This is where confidence turns into complacency, and this is where the paper market sets its final snare. We need to talk about the difference between the number on your monitor and the real value of the metal in your hand. That $120 price you are seeing, that is a paper reference. It is a future settlement. It is not an offer to sell you silver. It is not a guarantee of availability. It is not even a promise of delivery unless very specific conditions are met. Do not confuse a quote with access. Here's what I want you to do mentally if you cannot physically do it right now. Pick up your phone, call your local bullion dealer, ask them to sell you 1,000 ounces of silver for $120 per ounce. They will laugh at you. Not because they are rude, not because they are dishonest, but because they cannot replace that metal at that price. Right now, dealers are quoting $135, $140, even $145 per ounce for immediate delivery depending on form, and availability is thinning by the hour. That spread between paper and physical is the lie. And let me say this clearly. Premiums are not extra cost. Premiums are price discovery. When premiums explode, it means the futures market has lost control. It means the physical market is voting with real money. And once that vote starts, it does not reverse quietly. This is the decoupling. This is the snap. This is the moment where the paper market and the physical market stop pretending they are the same thing. For years, the system worked because very few people ever asked for delivery. They rolled contracts. They settled in cash. They trusted the system. Now that trust is cracking, and here is the trap. The paper price may fluctuate. It may even pull back. And when it does, the headlines will scream, "Silver crash, bubble over." That is designed to shake you out, emotionally, psychologically, financially. But the physical price will not follow. Because once supply is gone, it does not come back because price dips for a day. That is the lie. And if you fall for it, if you sell real metal for a paper number, you are handing your insurance policy back to the very system that just proved it cannot be trusted. So the question is not, is silver volatile? The question is, which price is real? And once you answer that honestly, the next question becomes unavoidable. What should you do right now? So what does this mean for you? What should you do right now? Let me be very clear, because moments like this do not reward confusion. They reward clarity. First, if you own physical silver, coins, bars, rounds, do not sell. Do not even think about selling. Do not let a screen price tempt you into giving up something that the system is openly struggling to replace. You are not holding a trade. You are holding insurance. You are holding the one asset in this market that does not require someone else's promise to function. Second, if you own silver ETFs like SLV, PSLV, or similar products, you need to seriously consider your risk. I am not telling you what to do with your money. This is not financial advice. But I am telling you what I see. You do not own silver. You own exposure to a structure that claims to track silver, and when markets are calm, that distinction does not matter. When markets are stressed, it matters everything. Ask yourself one question. Do you trust the exchange, the custodian, and the authorized participants to deliver real metal in a disorderly market? If the answer is anything less than absolute certainty, then you already know the risk you are taking. Third, if you own silver futures, you need to decide right now whether you trust the COMEX to deliver if this stress continues. Futures are not evil. They are tools, but tools can break. Paper contracts are only as good as the system behind them, and that system is now actively changing the rules to protect itself. Cash settlement clauses exist for a reason. Force majeure exists for a reason. Do not assume you will be the exception. Fourth, if you do not own any silver and you are thinking about buying, the question is not, should I buy? The question is, can I still buy? Because availability matters more than price when supply is breaking. This is not about timing the top. This is not about getting the perfect entry. This is about whether you can secure exposure to a scarce asset before the next phase begins. And let me tell you something uncomfortable. The longer this goes on, the less choice you will have. Not because silver will be expensive, but because it will be unavailable. Now let me say something important, and I want you to hear the tone, not just the words. This is not fear. This is not hype. This is recognition. Recognition that the system you were told was stable is showing visible cracks. Recognition that the rules are changing in real time. Recognition that the people who usually control outcomes are reacting instead of leading. You are not late. You are early to the recognition phase, but recognition windows close fast. And that brings us to the final question, the one nobody on television wants to talk about. Where does this actually end? Because moves like this do not resolve quietly. They resolve decisively. Now let me address the elephant in the room, the question that is sitting in the back of everyone's mind, whether they admit it or not. Where does this go from here? Because markets do not move like this and then politely return to normal. They do not explode, expose leverage, drain inventories, and then reset as if nothing happened. That is not how stress works. That is not how failures resolve. We are entering the final countdown, and this does not happen all at once. It happens in phases. Phase 1, the last train. That is where we are right now. This is the moment where price is still visible, quotes still exist, and supply is still technically available. If you move fast, if you know where to look, if you are willing to pay up, this phase is defined by disbelief. People say, this move is crazy. This will pull back. I will wait. Waiting is the costliest decision in phase 1. Phase 2, the void. This is the part almost nobody understands until they are living through it. In phase 2, trading does not stop, but access does. Dealers, quote, call for availability. Delivery times stretch. Exchanges introduce temporary measures. Volatility spikes, then vanishes, then spikes again. Not because the market is calm, but because nobody is willing to sell. This is where price discovery becomes erratic. Screens freeze, gaps appear, and people realize that the number they are watching does not represent an actual transaction anymore. And then comes phase 3. Call it Silvergeddon, call it the reset, call it whatever you want. The name does not matter. The mechanics do. Phase 3 is where the paper market either radically restructures or surrenders relevance. Contracts are settled in cash, position limits are enforced retroactively, confidence evaporates, and price is set where real metal changes hands, not where leverage dictates. At that point, $120 will not be the headline. It will be the footnote. Some analysts are now quietly floating targets of $150, $180, even $200 silver if delivery stress continues into the next quarter. And understand this, those are not moonshot numbers anymore. Those are clearing prices, levels where supply might actually show up. This is not a normal market cycle. This is not inflation hedging. This is not speculation. This is a paradigm shift. The silver market is transitioning from abundance illusion to scarcity reality. And once that transition begins, it does not reverse on hope or reassurance. It resolves when balance is restored, or when the system that failed is replaced. And here's the most important part. You do not need silver to go to $200 to win. You need it to stop being controlled. Because once price is honest, everything else reprices around it. And that brings us to the final message. The part I want you to remember when the noise gets loud, when volatility gets violent, and when pressure is applied from every direction. So, here is my final message to you. Silver did not surge past $120 by accident. Inventories did not drain by coincidence. The exchanges did not change the rules for no reason. The time for debate is over. The time for watching is over. The paper market is dying. The physical market is taking over. And if you are holding physical silver right now, understand this. You are not late, you are not reckless, and you are not wrong. You are holding the collateral of the next system, the asset that does not need permission, the asset that does not default. Do not sell. Do not let them steal your silver. Do not let them shake you out with volatility, headlines, or fear. This move is not finished. The target is higher. The timeline is accelerating, and the fundamentals are undeniable. This is paper to atoms. If this video opened your eyes to what is really happening in the precious metals market, do me a favor right now. Hit that subscribe button and smash the bell icon so you never miss an urgent update like this. The information I share on this channel could be the difference between protecting your wealth and losing everything to the paper market collapse. Like this video, if you are holding physical and you are not selling, share it with anyone you know who needs to understand what is coming. The mainstream media will not tell you this. Your financial advisor will not tell you this. But I will, every single day on Paper to Atoms. And here is my question for you. Leave it in the comments below. Are you holding physical silver or paper exposure? And after today, has that answer changed? I read every single comment, and I will see you in the next update. Remember, get out of paper, get into physical, go, go, go.